Okay, let's dive right into this. Welcome to This Explainer, where we're unlocking an elite insider playbook for transforming dry tax codes into the ultimate strategy for acquiring premium technology. If you've ever felt like upgrading your professional tech stack is just way too expensive, well, you're going to want to pay very close attention to the mechanics we're breaking down today. So, do you want the IRS to essentially fund your new 8K monitor or maybe a luxurious AI workstation? I know, it sounds entirely too good to be true, doesn't it? But we're going to look exactly at how freelancers, remote pros, and small businesses are legally minimizing their tax liability while maximizing their hardware. This isn't about cutting corners, it's about leveraging the tax code exactly as it was designed to empower your business growth. The absolute prize in this heist-like strategy? A massive 100% purchase price deduction. And the best part is that this is fully available right now in the current 2026 tax year. So instead of getting a tiny fraction of your money back over time, you're realizing the complete benefit of that deduction immediately. It all boils down to understanding the engine driving this whole thing. Section 179. Often called the $1,000,000 home office loophole, this is a tax code provision allowing businesses to deduct the full purchase price of qualifying equipment in the current tax year. You buy the gear, you put it to work, and you deduct the total cost from your gross income. It is literally a game changer. Here's our exact playbook for today. We'll cover the $1,000,000 loophole, what tech actually qualifies, the phase upgrade strategy, navigating the documentation trap, and future-proofing your tax savings. Section 1. The $1,000,000 loophole. This perfectly illustrates the immediate cash flow benefit of our strategy, taking the full cost deducted right now in 2026 versus depreciating that equipment over a 5-year crawl. If you buy a massive workstation, traditional depreciation means you slowly write it off piece by piece, year by agonizing year. Section 179 lets you take that entire financial benefit immediately, which keeps your capital exactly where it belongs, working for you inside your business today. Now, we really need to redefine what we mean by business equipment. We aren't just talking about basic office supplies or a standard laptop. We are talking about classifying luxury, top-tier setups as essential business equipment. High-end tech like massive 8K displays and AI-integrated workstations absolutely qualify under this code, provided they are essential to how you actually generate your revenue. Section 2. What tech actually qualifies? Honestly, you don't have to limit yourself here. You can focus on absolute premium hardware options. The code allows you to go after high-impact assets, like acquiring a dedicated neural processing server to run your local AI models, or even investing in professional-grade VR collaboration tools so your remote team can work in entirely new dimensions. But of course, there's a catch. To ensure your luxury desk setup meets IRS standards, it must fit the strict definition of tangible personal property. What does that mean? Basically, physical, movable assets used for your business. It has to be tangible gear you can physically touch and move around. So a custom built-in desk might not qualify the same way a freestanding state-of-the-art server rack does. Now, here is the golden rule for remote professionals. You absolutely must hit at least a 50% business use threshold to trigger the full deduction. If you use that amazing 8K monitor 51% for architectural rendering and 49% for watching movies, you qualify. But remember, your deduction is proportional to your exact business use. Section 3. The phased upgrade strategy. Strategy is everything here, guys. You're going to want to leverage the 2026 total deduction limit to strategically acquire massive amounts of what is essentially free tech. By breaking down the limits, you can calculate exactly how much tech you can acquire this year based on your specific income bracket. You're effectively using money that would have otherwise gone to taxes to completely fund your business upgrades. Just look at the math. Buying high-performance assets heavily outperforms entry-level gear. Why? Because premium tech retains its value far longer while actively lowering your tax bracket right now. If you buy cheap gear, you'll be replacing it in a year, and the tax benefit is minimal. Go for the high-performance assets. They give you a much larger immediate deduction and future-proof your workflow. This maneuver requires some pretty strict timing. Your early planning happens January through October, but you really must purchase before the Q4 rush in November to ensure your equipment meets the absolute hard placed in service deadline of December 31st. You can't just buy it on December 31st and leave it in the box. It has to be set up, turned on, and ready for business use by midnight on New Year's Eve. Section 4. Navigating the documentation trap. So, a huge mistake that will practically guarantee an audit is failing to clearly separate a professional rendering or coding environment from a personal gaming setup. If your workspace looks exactly like a high-end gaming stream, the IRS might have some questions. You need to clearly establish that this environment is a dedicated professional space meant for revenue generation. To protect yourself, literally just hand this specific checklist to your CPA. You need your digital receipts properly saved and categorized. Crucially, you need detailed usage logs to unequivocally prove that your new $10,000 workstation is 100% for business. Finally, ensure your CPA correctly files the Section 179 election on your upcoming return. Documentation isn't just paperwork, it is your ultimate shield.
Section 5. Future-proofing your tax savings.
You really have to act with some urgency here because current 2026 tax laws might shift in totally unexpected directions. Tax codes are always evolving, and the generous limits of Section 179 could easily be modified. So locking in these high-value deductions right now is an incredibly smart, protective move for your business's financial future.
But you've got to be careful. What actually happens if you decide to sell your high-end gear next year? Let's say you want to upgrade again. Well, if you try to liquidate that tech prematurely, you could trigger a nasty surprise from the IRS that completely unravels your financial strategy. You absolutely must understand the recapture rule. This is a tax provision that forces you to pay back those previously claimed tax deductions if an asset is sold too early, or if your business use drops below that critical 50% threshold. You've got to actively manage your assets to strictly avoid paying back taxes if you decide to sell your high-end gear before its required lifespan is up. Let's see how this all builds into a brilliant repeating cycle. Step 1, claim the deduction on your premium hardware today. Step 2, bank those massive tax savings. Step 3, upgrade via a 3-year tech rotation plan. You are essentially using today's tax savings to completely fund your next major hardware leap 3 years from now, creating a totally sustainable, repeating cycle of elite tech acquisition. The playbook is fully in your hands now, and the clock is actively ticking down on the 2026 December 31st deadline. This isn't just about saving a few bucks. It's about radically upgrading your capabilities. So the only question left to ask yourself is, are you ready to let the IRS finance your ultimate workspace? And what piece of elite, high-end gear are you going to buy first?